we're getting ready to go live here. All right. And then Facebook go live. All right.
Super.
We're set to go, buddy.
All right. It's looking good over here on this side.
Good deal. Well, hey, man, good to see you.
All right, good to see you too. Welcome everyone. This is the Tuesday, March 7th edition of the Flight Path. It is 3:52 p.m. Eastern. I'm Ted, and this is Josh. Or yeah, this way. There.
How's it going? Yeah, back from Mammoth Lakes. We got about 20 feet of snow. It was pretty crazy. I mean, I've never seen that much snow in my life. We actually left Sunday, and we were worried we couldn't get off the mountain. We had to have a police escort down to to get off the mountain. So, but once you get off the mountain, it's fine. So we flew out of Reno. So the drive from Reno to Mammoth Lakes was actually my favorite part because the Sierra Mountains, I mean, I don't know if you've ever seen them, but they are beautiful. I mean, it's just, you feel insignificant when you're driving through the mountains like that.
Yeah, I had the pleasure of being on tour in 1999. 1999. Flew out to San Francisco and then drove over to Reno and took the I-80. There was a mountain pass that we were able to, that thankfully was open during that time. And then we drove from Reno down to Bakersfield and then back up to SFO to fly back. But man, yeah, that like the terrain in the U.S. West is just it's jaw dropping because golly, I don't even know how to describe it. I mean,
it's the most beautiful place in the world. And while I was out there, of course, I get into the discussion of taxes because you're in California, and I would love to live in California, right? It's my favorite place in the country, but it's prohibitive, right? Like we all work so hard for our money, and I'm not a decamillionaire, right? I don't think you are either. Like unless you have just unlimited amounts of money, it's just prohibitive. It really is. But the other way to look at it is, I've heard the other argument is, look, if you really love it, maybe it's worth paying half. I don't know. You can make the argument. I don't agree with it, but I could see how you could make the argument.
I think I guess it's just to like expand on the point that you're making here, or you're expressing around like the level of income. I guess it just depends on what your income structure is. If your business is domiciled outside of California and you're able to benefit from in that regard, to not have to pay nearly as much as you would if you were domiciled in California, or if you're a tech billionaire and you're literally your assets are out earning. Let me put it this way. If your assets are producing an income that if you worked 24 hours a day, 7 days a week, every day of the year, that you wouldn't even come close to earning that kind of income, then you're in a good spot. I mean, that's really what I think does it. It becomes negligible, the costs.
Well, my understanding is it doesn't matter where your business is domiciled. Like the state taxes pass through to where you live.
Ooh, okay. Yeah, I didn't know that.
Yeah. I mean, you could register your corporation in Delaware, and don't hold me to this, I'm not an attorney or a tax specialist, but there's very few ways around living in California and not paying that. Now, I'm sure the ultra wealthy have more means than you or I might to deal with that, but different discussion. California is beautiful. It's a great place to visit. I think today we want to get into what's the difference between Bitcoin and Ethereum, and we're not going to talk about it technically, right? Because if you're around and you've been in crypto, you understand that Bitcoin's proof of work, Ethereum's proof of stake. Those are drastically different types of protocols. But we want to just get into a conversation of kind of looking at these maybe a little bit differently than people have thought of. And we're going to reference a Substack article from Raoul Paul. He's the creator and owner of Real Vision, something that I would recommend everybody check out. He catches a lot of grief from Bitcoin maximalists, so that's probably the first reason you should check him out. But he produces a lot of good work, and again, like he's thinking, like he's trying to understand what's going on. About 3 or 4 years ago, he made the shift into crypto, and he's gone all the way in. He produces a lot of good content, and anything with anybody like who's giving an opinion or trying to figure this out, they're not always right all the time. But that doesn't negate the fact that the amount of work he produces and what he puts out there for free is unbelievable. I mean, I've learned more about the macro I can't say economy than I ever wanted to from him. And he puts it all out there mostly for free. He's got subscriptions, right? He's not doing it totally for free, but it's a reference I think everybody should follow and listen to. Right now on the screen, we've got current prices of assets, and we're down a little bit today. We've gone through same stuff we were going through last week. We've got the SEC, we've got GBTC going to court and challenging the SEC's position that a Bitcoin ETF shouldn't be allowed. I think it's all political horseshit, and we talk about that a lot. But overall macro picture on crypto prices. You had the Powell talking. The Powell come out today with a talking head for the Feds. Ted, if you want to kind of illuminate a little bit on what he said and why it matters to crypto.
So the underlying issue today with what Jerome Powell, which is the chairman of the Federal Reserve, stated was that the outlook for interest rates in the U.S. is that the economy is actually stronger than they had anticipated, and the risk of inflation going higher is high itself. Therefore, from a policy perspective, the Federal Reserve must act to tame inflation and keep it from getting out of hand and try to bring it back down to quote unquote reasonable levels. And in the Fed's arsenal of tools to do that is simply to either raise interest rates, which is what they talked about today. It's called being hawkish. So the hawkish tone today, and it wasn't just the tone, it was the words that were used to illustrate that the Federal Reserve may have to be more aggressive than they originally thought, which harken back or rewind the tape a few weeks. The next rate hike that's on the table for this month of March is on the 22nd of March, is when the FOMC will, which is the body of the Federal Reserve folks, will formally announce the decision that they've made concerning what the Fed funds rate or what the interest rate will be in the U.S. So what I'm trying to communicate is that the tone with the words told the market today that the Fed is going to be more aggressive in raising interest rates because the data is suggesting that the economy is stronger than it was. And this is probably catching some people off guard because, last year into the end of the year, there was some rumblings about recession coming in 2023 and that the economy is going to weaken. But here we are. We're approaching the middle of the month, near the end of Q1, and allegedly the data is suggesting that the economy is not as weak and that inflation is not lessening, or inflation is still strong and showing up in places where the Fed is looking. So the take or the response that we saw across the board today was that risk assets were lower and crypto was lower. But interestingly enough, I think that equities reacted much more strongly than crypto assets did. Take that with a grain of salt. But in broad strokes, I'm interested to see, for example, the question I'm asking today is, well, why isn't Bitcoin lower than it already is at this point? Why hasn't, we were in the dumps, so to speak, in January, like 16,000 and some change. And yet we are still above 22,000 last time I checked a few minutes ago.
It is interesting, right? Because part of what we look for and look at as crypto investors is, why we got into this was because we realized some of the absurdity that is the current debt-based system, right? And so that's what's attractive about an asset like Bitcoin in particular, is that it's an asset that lives outside of that system, right? So what we look for as crypto investors is for this these crypto markets to eventually decouple from traditional markets. I think we're a ways away from that. I think that right now we're just too small. But I think that changes in the future moving forward, and I think more and more people are starting to realize that. You've got a lot of really smart people that are just saying, like, guys, like, what are you doing? Like, you've got this whole system is it's what we got, right? It's the what we've got to live in and deal with. And I think with Bitcoin and why it's so awesome and provides hope to so many people is because it's an opt out of that system. It's a way to say, look, we don't agree with this. This system is rigged. It's full of middlemen and rent seekers. The normal person, the normal guy and girl, doesn't have the same chance as those that are connected. Like, this isn't fair, okay? And so that's something that a reason I got into Bitcoin and crypto, and I think what we're trying to help people do, and why we want to get people into Bitcoin and crypto, is because of that reason. It's a system that lives outside the current corrupt system. And so that being said, I think let's talk about this article on Substack that Raoul Paul put out, in which he talks about Bitcoin and Ethereum mainly, and looking at them in terms of economies is rather individual assets. And so, do you want to start out, Ted? Did you have anything that you took away from this that was powerful?
Yes, it was interesting to. I'm gonna pull bits and pieces from the text of the body of this email, which was really I'm really glad that I was able to be reminded that these things are they're greater than just the sum of the parts. So what I'm trying to communicate here is instead of looking at them just as or starting with Bitcoin, Raoul Paul talks about what's behind Bitcoin, and if you think of it in a different way, and his words are, I want you to think about Bitcoin and Ethereum, like the Bitcoin. He says the Bitcoins and the Ethereums of the world, but I'm not gonna mince or split hairs. I'm just gonna say, let's think about Bitcoin and Ethereum today as instead of just thinking of them as assets, in this case, digital assets, what one can buy and hold as property in a manner of speaking, but think of them in terms of entire economies. And he proposes in this that once you do so, it'll be not only easier to understand, but more you'll be more prepared to navigate the future. Is what I like. That's like the first thing that I took away from that. And it goes on to talk about the narrative, which you articulate a little bit about, governments have they're destroying the value of our currency, like the U.S. dollar, or in Europe it's the euro, or in Japan the yen, et cetera, down the line. Okay, and the talks a little bit about also that the he probably is alluding to some might say that Bitcoin is a little bit, he kind of compares it to the Catholic Church. Okay, and even makes a reference to the gold bugs of the world, who tend to be really into gold and not really into anything else, which that's a fair thing there. But to me, there's a spectrum, and people fall on the spectrum but anyway, that's not what I'm really trying to get down to, is that basically in the Bitcoin economy, you have, or if you think of Bitcoin as an economy, you have the Bitcoin is the only asset. And if you want to allocate other things, or if you want to, let me say that a little bit clearer. If you want to allocate your capital that you have in the Bitcoin economy, you have one choice, and that is to buy and hold Bitcoin. Okay, so that's one way to look at Bitcoin as an economy, is that if I have capital that's been issued by a central bank in the country that I live in, and I want to hedge against the debasement and devaluation of that, if I'm going to participate in the Bitcoin economy, there's not really anything else for me to do other than to purchase Bitcoin and hold it. And the idea is that as the capital that I once possessed, I exchange or trade that for Bitcoin, and I hold that today, that in 1 year, 5 year, 10 years, as the capital that I recently parted ways with becomes less, or there's less buying power associated with that, meaning I need more of it to buy the same things, that I will be protected and my value will be stored in this other asset, in this case, Bitcoin. And there's not really a whole lot else to do in that economy. It's just buy Bitcoin and hold it. So that's his way of communicating that there's not a lot going on. This is in stark contrast to Ethereum, which we'll get into in a minute. But I'll pause there for a second. Is there anything else that you would add around that example that Raoul Paul made and the way I've articulated it and trying to summarize it and make it simple?
Yeah, no, I think you got it. I mean, basically what he's saying about Bitcoin is it's relatively straightforward. Bitcoin is what it is. There's not a lot of innovation happening on Bitcoin, but there doesn't necessarily have to be, right? Because Bitcoin as is works for what it was designed to do. Now, there is innovation happening on Bitcoin. Let me take what I just said back. There are people trying to do things on Bitcoin, which I think is a positive thing, right? But basically, when we're talking about what's the difference between Bitcoin and Ethereum, I think the general idea of this article is something to consider, right? And for people looking to understand why, Ethereum might be something that is worth taking a look at. Sorry about that. I think this is something that everybody should consider and looking at these things as economy instead of assets. I think it'll kind of help wrap your mind around the difference between the two. I don't necessarily agree with what he's saying about like the Catholic Church back in the Dark Ages. Like, I think that's a little much. Like, I think he's been worn out by the maxis. I don't like that analogy at all. But I get the general idea of what he's trying to say. Basically, Bitcoin is what it is. There's no changes or innovation coming. It's designed to be an outlet from governments that have lost their way in printing unlimited amount of fiat currency. And I think it's important to remember this is why there's a place for both of these in your portfolio, because they do very, very different things. Okay. And so like you can't lump Bitcoin and crypto into, it's all the same thing, because it's not. I think there's a place for Bitcoin in your portfolio. And I think for reasons that, we're going to outline and then Raoul's going to outline in this article, is that Ethereum is, and the rest of crypto, and granted, that saying this with a grain of salt because most of crypto is garbage, but there are projects that are very valuable, and I think that's basically what I wanted to add to that. If you want to talk about what he talks about Ethereum, then we can go from there.
Sure. So the other example in this like mini novella, I'll call it, that he wrote here, is it transitions and talks about the economy of Ethereum, and he makes a couple of interesting statements. And I think one of the first things to unpack or talk about is that Ethereum is much different from Bitcoin in that, I mean, it is architected to be functionally different. There are lots of things that you can do on top of the Ethereum blockchain that you don't necessarily or can't necessarily, or you wouldn't necessarily do with Bitcoin or on the Bitcoin blockchain or on the Bitcoin network or in the Bitcoin economy that you can do in the Ethereum blockchain, Ethereum network, Ethereum economy in this example. And where he goes with this is he makes the comparison that Ethereum, the Ethereum economy is like the economy here in the US. Okay. And that ETH, which is the digital asset, is much like the US dollar, except that with the way that the changes that have been made to the Ethereum blockchain and the way that supply is managed, it's considered to be now deflationary. And what that means is that there's not more and more and more Ethereum, just like there's not more and more and more US dollars being put into the system, thereby devaluing them, meaning you need more of them to buy the same things, one day or 1 year to the next. And that this consensus mechanism that the Bitcoin blockchain is the proof of work mechanism is different on the Ethereum blockchain. It's what's called staking. And you can consider that what he calls the central bank mechanism that is dictating what the policy is. He calls it, he says that it's that in the Ethereum economy, the staking mechanism is its quote unquote central bank, and it is quote adhering to responsible monetary policy to design and ensure that the value is upheld and not debased, unquote. So what I'm trying to or what I think he's communicating, and the thing I'm trying to also just reiterate and put some more like focus and help there be more understanding about this, is that the idea is that you can, like, for example, in the US economy, the dollar, you can use your dollars to buy things like real estate. And then over time, the real estate goes up in value. While the monetary policy changes periodically, the dollars may not be able to buy quite as many things in the future. So the idea is you take some dollars today, put them into an asset like real estate, or I'll talk about Bitcoin in the same way here as a store of value asset, similar to real estate. We don't have to get into all the reasons why they might not be the same, or similar, I should say, but you would take your money, your capital, put it into this other asset and be protected from debasement over time. But what he's talking about here is that the consensus mechanism is designed to protect Ethereum from being debased over time. And that in and of itself is what he says is, quote, a pretty good reason to own ETH, but then goes on to talk a little bit more about it. So I'll pause there for a second. Is there anything that I could clarify there, or something that you would add around like the fundamental base layer, so to speak, in this context?
Yeah, and so if we're talking about, the title of the stream is what's the difference between Bitcoin and Ethereum? And Ethereum is a proof of stake network where a lot of Bitcoiners will say, hey, look, X amount of people can control the supply. That's not a true money, right? Okay. And so like, I'd agree with that, but that doesn't take away from the fact that, you've got an asset here. If you look at it like an economy that people are choosing to participate in, right? And people are choosing to participate in the Ethereum economy. And if you're a Bitcoin only person, you can choose not to participate in the Ethereum economy. All right. And so I think the big difference there is with Bitcoin, you're on a proof of work, protocol where nobody can change the rules at any time, right? It'd be very, very difficult. You have to have a 51% consensus across all the nodes, okay, to change the rules of the game. With Ethereum, that's not necessarily true. And that's where people kind of get, I guess, butthurt if you're a Bitcoin only person. Now, in the context of economies, there's trade-offs in everything, right? Okay, so because you can't change the rules in Bitcoin, it makes it a lot harder to develop things on top of it. Okay, and so there's a lot of technical stuff involved in that, like block size and all different sorts of things. But for the purpose of this conversation, I just wanted to add for people that are new to this and trying to understand and unpack this, that those are things you have to consider when you decide which economies, if we're going to look at these as asset, or instead of assets as economies, which one do you want to participate in?
Yeah, another thing I would add is that the technicalities of how proof of stake works versus how proof of work works are pretty, they're complex, yes, but there's a good saying is that you don't need to know how the watch is made to be able to tell what time it is. So I think that for a lot, like for the average person or the every person who doesn't have a software background, doesn't understand systems and networks at the deep technical layer, how they work and like what their protocols and all this language that can be very intimidating. I would just say that I think one of the genius parts about this article is that Raoul Paul's not talking at all really about the technical fundamentals. He's comparing it to, making the comparison to economies is really important here, because the next thing that he goes on to talk about is that this idea of yield, and makes the example of buying a treasury bond, which basically pays you to hold it, and it's a way to protect the value of your dollars in the U.S. For example, if you take U.S. dollars and you buy a treasury bond at say 5%, then you're earning what's called a real yield. And this idea of staking in the Ethereum economy is to give people the ability to put their Ethereum today you lock it away to have it staked, and you are being rewarded, or you're earning for that. You're being rewarded, in a manner of speaking, for participating in the staking process.
Well, and then to interrupt you real quick, sorry,
Yeah.
on Wall Street, what that's called is a productive asset, right? And there's a difference between Bitcoin and Ethereum in the sense that you can't earn a yield on Bitcoin directly, okay? And so what Wall Street's interested in, what Wall Street likes, is productive assets. And a 5% yield on Ethereum is a productive asset. I just wanted to throw that in there.
It's a really important thing. I mean, we were talking before about how, different people in different phases of life, in different regions and different sectors of the that participate, or more importantly, don't necessarily participate in the labor force, may be just fine with taking some of their capital, allocating it to ETH, and then staking it in order to earn a yield as an alternative, so to speak, to buying treasury bonds, for example. So it's, to each their own, and everyone's at a different place, and they have different needs, different desires, different wants. And what I'm trying to spit out here is that, depending on who you are, where you are, how old you are, how young you are, you may, on one end of the spectrum, you may not care about yield. You may not care about owning productive assets. I know that at one point I didn't know what the heck a productive asset was, and I just wanted to make money. And what is making money? It means there's different ways to make money. But one of the things that's interesting about this productive asset concept is that in the digital world, in the Ethereum economy, it's baked into the fundamental, or it's fundamentally possible because of the construct, this consensus mechanism being proof of stake, is that you can earn a yield and you can own a productive asset. Let's say that I am physically unable to work, or more importantly, I'm not able to participate in the labor pool in the way other people do. I'm not trading time for dollars and earning an income. But let's say that I have some capital and I'm able to put that to work in the Ethereum economy and earn by staking, and it's enough to pay my expenses from one month to the next, and I can get my healthcare and I can get my other things. I'll ask the question is, what's fundamentally wrong with that, or is there anything fundamentally wrong with that? And I would say no.
No,
Whether I like Ethereum or not.
Yeah, and that's another important point. Like, when you're learning about all this stuff, again, I want to go back to the point of these are as Raoul puts it, these are economies you can choose to participate or not participate in. And you might look at this and say, okay, well, I've done my research. I understand this from a technical perspective. I don't like the way Ethereum is structured, and that's okay, right? Like that's there's nothing wrong with that. But the rest of the world seems to be thinking that Ethereum is doing some pretty cool things, and other assets in crypto. So when you talk about the differences in the two, I think it's always important to remember that, like I said earlier, there's trade-offs in everything. But if you're going to look at some of the benefits of proof of stake like Ethereum, you've got to look at some of these things like Raoul talked about. And I think one of the interesting things he talked about too, is I'm trying to find this, is he goes on to talk about, how he can basically own an NFT, which is a non-fungible token on Ethereum, and basically use that as a call option on the price of ETH, right? And those are concepts that are somewhat in depth. But the main takeaway is you can't do that on Bitcoin today, okay? And so there's projects going out. There's something called Bitcoin Ordinals where they're trying to do what's essentially NFTs on Bitcoin. I think it's cool. I think it's great. Any kind of innovation, I think, is worth trying. But people are doing that on Ethereum much more. And so I guess what I'm trying to get to is that, when we talk about the differences, that Bitcoin offers kind of, I guess, a sound stable, can't change it, like this is what it is, this is what it's for. Whereas Ethereum, you have a whole other array of different things you can do on the network. Does that make sense what I'm talking about there, Ted?
Yeah. I want to the thing you touched on briefly prior, this idea, this concept of a call option on my ETH position, meaning if you take your capital, allocate it to ETH, and then you use your ETH to acquire NFTs. It sounds fancy. Oh, like my NFTs are a call option on my ETH position is just another way of saying, for example, today, well, I'm going to take my US dollars and I'm going to, or first, let me back up. I'm going to take my labor, my time, and my energy and my life, and I'm going to trade it for US dollars. And then I'm going to allocate my capital into real estate because that's a call option on the value of my USD position after trading my labor, getting compensated in US dollars. And then I'm going to put my US dollars into this piece of real estate, which I have done recently, with the understanding and the desire that in 10, maybe 12 years from now, when I'm in a different phase of life, I will be able to then take that piece of real estate and sell it for a heck of a lot more than I paid for it. So this is what, like, the magical part, or one of the magical things that happened in my mind after reading this a couple times, was that it helped me understand the opportunity that there are some people that hate Ethereum and would rather die than own it, and that's fine. But there's plenty of other people in the world that would rather die than own stocks, or they'd rather die than own gold, or they'd rather die than own Bitcoin. It doesn't matter what you think of these things. These are just, this is a possibility. So I wanted to clarify or talk about this idea of, like, taking what he says here about using NFTs as a call option on his ETH position. I could say I'm using real estate today as a call option on my USD position in the real world, meaning in the US economy, not the digital economy that we call the Ethereum network. So I think that this was one of the stronger points to me, or at least as I read this was one of the, like, more illuminating moments where I realized why the proof of stake mechanism was going, or what the benefit of participating in the Ethereum economy in this example, without doing any damage to, like, how I feel about Bitcoin or what I like about Bitcoin and the way I allocate in Bitcoin. It doesn't take away from that. It doesn't otherwise diminish Bitcoin's value. It's just, there's this other thing called the Ethereum network / economy that has a whole different ecosystem, in a manner of speaking. So
And
I'll
I
pause
think
there.
that's the main takeaway from all this, is that if you really look at these as economies and different ecosystems as opposed to assets, it starts to make a lot of sense. And you could say there's a lot of people that look at Bitcoin as a call option on the future, right? And so just owning Bitcoin is a call option on the future. So what Raoul talks about a lot is something called moving further down the risk curve. And essentially what that means is the less risky something is, the less likely you are to get a higher return. And correct me if I'm wrong on this, Ted, but, like, when you talk about Bitcoin versus Ethereum, well, Ethereum's further down the risk curve than Bitcoin. And then NFTs on Ethereum are further down the risk curve than Ethereum, right? And so what you're looking at, what Raoul is talking about, is owning NFTs on the Ethereum network as a way to first of all, he's taken a bet on Ethereum and using the NFTs to also increase his both Ethereum position and his US dollar worth is the way I understand that. And some people will say, okay, well, whatever, moving down the risk curve is kind of a fool's errand, but that's why we're in this space. I mean, that's, anybody watching this or listening to this understands that, Bitcoin and cryptocurrency are new technologies. And if you're investing in this space, you are taking risk. Well, what we talk a lot about is, mitigating that risk so you can stay in the game, keep playing and not lose your shirt, right? Because both Bitcoin and Ethereum, I think, represent asymmetric bets, right? Because if you're right about the direction of these assets over the long term, you don't have to go crazy and invest your life savings into these things. And so I like this article because I think it does a really good job of framing the difference between Bitcoin and Ethereum. If you look at them as economies, it doesn't talk about the technical differences, which I will say are very important, right? But for anybody getting new into this space and new to it, there's a lot of challenges for both of them moving forward, but the same with any new technology, right? And so I think the article did a really good job of explaining the difference between Bitcoin and Ethereum in a way that's understandable for people that aren't technical.
Yeah, one thing I'll add real quick, this risk curve thing that he talks about is basically think of like closer to you is less risk, and if there's this arc that goes away from you, called the risk curve, the further out on the risk curve you go, the higher the yield, the return, but the higher the risk. So they say that higher risk, higher reward is a thing. And that's true in taking any sort of. So if you are really risk averse, you might say, well, I'm just going to take my US dollars, put them in my savings account today because the Fed keeps raising interest rates, so I can get 4.5% and take absolutely no capital risk at all. Meaning I'm I'm not very far out on the risk curve at all. There's very little risk at this part of the curve. But let's say that I want to buy stocks. There's a little further out on the risk curve. You're trading your US dollar, you're getting some shares of stock that you hold you hold as collateral. Think of it that way. And then you either sell your stock or you earn a dividend. So people get all up in arms about earning yield on your Ethereum, but how many of those same people, I would ask, own stocks in a portfolio or a stock bond portfolio mix that have dividend paying stocks, growth stocks, and then have bonds that are paying? I mean, they're earning yield. That's what these assets do. And they're further out on the risk curve. And then you can go even further out. You can say, well, I'm going to buy just tech stocks, or I'm going to buy penny stocks, or biotech stocks, for example. They're even further out on the risk curve, and they're much higher risk, but the reward is much more interesting, but at the cost of higher risk. And then you've got crypto in like Bitcoin and Ethereum in this example. They're even further out because depending on who you ask, Bitcoin is backed by nothing. And that's a hard concept. People who don't understand computers and understand networks can't make the connection in their head that Bitcoin is a global network that is raging 24 hours a day and can't be stopped, without going down that rabbit hole. It's even would be considered further out on the risk curve depending on who you are and what your appetite for risk is. So it really boils down to the individual. Just like every single person looking at a Monet sees something just a little bit different. And
I think that's
I
great.
wanted to add the clarity.
No. That was awesome. That was really good. Yeah. And I think that, when you look at crypto and how to allocate your portfolio, that's something that everybody needs to consider. And there's ways to do that. I've got something pulled up right now from, let's see, Bloodgood BTC. And he kind of talks about, the risk curve and different ways to structure portfolios. But yeah, generally back to the article, though, I think that when you take all that into consideration and you're looking at these two assets and then Bitcoin versus crypto in its entirety, I think what you brought up is a good point, because we're in this so much. Like, we look at this as it's its own little ecosystem, but people outside of this look at it and go, you guys are all nuts, right? You guys are all crazy. And so It's fun to learn about, and it's fun to kind of understand it. But again, I really like the way he summarized this. I really like the way he broke this down. Don't agree with everything. Don't agree with all the analogies. But for the user of the end product, right? Or somebody trying to decide what ecosystem and economy they want to participate in, these are the differences you need to understand.
Yeah, I would be suspicious if I agreed with everything in this article. That would be red flag number one. What I am thankful for is that I don't, or that he's willing to publish this and not try to please everyone, and me especially. I mean, I'm pretty sure that Raoul Paul doesn't know who I am and that I exist, but that doesn't stop him. And what I might like somebody like me might think of his writing doesn't stop him from publishing this, because what I've learned over the years, especially as I've talk about like wandering way off the deep end on the risk curve, is I don't own stocks, I don't own bonds, I only own crypto, mainly Bitcoin. And to your point that you just made a moment ago, there are millions, if not a billion people around the world, for example, that would look at a crypto only portfolio and say, you are out of your mind. And there's no way on hell I would ever allocate all of my money into a crypto only portfolio. So I might be the crazy one, for example, depending on who you talk to. Then there are others like me who think that it's ridiculous to have a 401k. And but that's just my personal opinion, because I think about these things differently. I happen to have a software background, like working with systems, networks, computer programs, supporting them, understanding how software and how things talk over the internet, what internet protocols are. That's all great stuff. But if I don't know those things, then none of this stuff makes any sense, perhaps, and
Well,
it's
I
a very
can,
tough sell.
yeah, and I can tell you my perspective on this because this is funny, right? It's interesting that your perspective is from the software background. My perspective is from an entrepreneurial background. All I know how to do is take risk. In my mind, I don't know how to make money a safe way. Like I just don't. Any money I've ever made in my life has been from taking risk, and so I look at something like this, and I can quantify the risk in the sense that whatever I'm going to lose is whatever I put in it, right? And that might sound really simple, but after having taken risk my whole life, I can tell you that when you look at different opportunities, like let's say a restaurant, right? When you open, which I have done and failed at, right, as an investor, your initial investment is not your only money you can lose. There's always ongoing costs associated with it, right? That come out of nowhere,
Yeah.
right? Real estate's the same
Yeah.
way. Online businesses, okay? So when I look at crypto from a risk perspective, I can say, okay, look, I think that say I have $100,000 and I want to be conservative. I'm going to allocate 5% of that, which is $5,000 to Bitcoin, okay? Or I could say I'm going to allocate 10% to crypto, and half of that's going to be in Bitcoin, and half of it's going to be in crypto. The thing is, I know the risk, right? And the risk is whatever I invest, okay? And so when I life, right? And so that's something that I think is really important. I know the chances of me losing whatever I spend on that might be higher, right? And so the perceived gain also could be higher. But I think it's interesting. Your perspective is a software specialist, and mine's just entrepreneurial risk taking and investment. And we both came to the same conclusion with Bitcoin and crypto.
I want to point out something about NFTs. Like he makes the comparison to think of NFTs almost like real estate. So in the Ethereum economy, NFTs are like real estate, meaning in the US economy, there's housing, real estate. You can buy that, and it typically protects your money over time. What is really easy to do is you hear the word NFT, and this is just human nature. We immediately think of all the horse crap and garbage that people have, quote unquote, wasted their money on by buying these buying JPEGs on the internet or buying digital pictures on the internet that are now worthless. And I'll say yes, there are plenty of people that have lost money by buying NFTs that are now worth a lot less than they paid. But in the same way, just the point I'm trying to illustrate here is that in the same way that you can make a poor NFT purchase, you can also, in the real world, in the US economy, for example, you can make a poor choice and purchase a bad piece of real estate that doesn't appreciate in value over time. It can end up costing you money. You can end up losing money by owning it, kind of like the restaurant example you made. It sounded like a great idea, but at the end of the day, it ended up not working out. And it's just as viable, or should I say, it's just as possible to make so someone's opinion of NFTs may be poor, but they can turn around and make the same types of choices and decisions about what they're buying in real estate, for example, and they can perform just as terribly. So it just depends on what you're buying. And if you're, yeah,
I pulled up the Bored Ape Yacht Club, which is a NFT series on Ethereum. So, it's funny you were saying that, right? As people are looking at a NFT of a Bored Ape that's worth $72,000. Well, more than
yeah. I mean, I'm not here to judge like this idea. Like the reality, whether someone likes it or not, is that human beings, will spend their capital, whatever that is, on things that they perceive to be of value, and all of us do this. In the same way that the Bored Apes sold for record prices, and people get all up in arms about, some people. The same type of thing happens. I happen to be an automotive enthusiast, and I've witnessed in the car market people doing the same exact thing for a new car that comes out. It's limited supply. The supply chain has caused all of these delays, but people want what they want when they want it, and they pay exorbitant amounts of money over sticker price. For example, I saw a Facebook post in an enthusiast group where someone was selling a latest generation Corvette Z06 that they paid $75,000 over sticker, so that they could be the one that owned it instead of just waiting a year or maybe more. It's no different. It's the same energy. This person was trying to sell the car. Get this. They were listing it for what they paid, and people were roasting this poor guy, saying, look, man, you're the one that made the bad decision to pay 75 over a sticker, and now the market doesn't support that. So yeah, maybe try sell it for MSRP, and you'll just have to write off the 75K. And I'm just thinking, that's more than some people make in a year. And this person is, facing that type of, quote unquote loss. It's not that much different, though. So all I'm trying to say is that it's easy for people to criticize individuals that they don't know, never met, never will meet, who buy a Bored Ape for 72 ETH or something like that, and then it's worth 10.
It's a market, right? This isn't a phenomenon that's unique to crypto, right? There's a market, and there's people
Exactly.
in the crypto. There's people in this crypto market that are more knowledgeable than others, okay? And so these people that are spending $100,000 on Bored Ape Yacht Club, okay, they look at the Ethereum economy, and they believe that the Ethereum economy has staying power, will be around in 50 years, and that when you buy Bored Ape, 262 or whatever it is, that they are purchasing something that will have value into the future, right? Now, whether they're right or wrong, I don't know. I think there's a lot of validity behind NFTs. I think most NFT projects will fail, not because NFTs will fail, but if you have 100,000 collections of 10,000 unique images each, not all of those are going to hold value forever, right? And so same in real estate, right? Not every real estate property is worth, $1 million, and that's okay. That doesn't negate from the value of real estate or to say that it's not worth anything at all. But I think it's interesting to think about this in terms of other phenomena that are similar that happen outside of crypto, right? Because at the end of the day, human beings are what's driving this, right? And so our emotions and reactions don't change whether it's a Bored Ape Yacht Club or a Ferrari, right? It's the same principles behind it. So
there's another.
That's a good. Go ahead.
This would be a good place, or good last thing to talk about is one of the paragraphs here is, I'll quote, as is the case with any investment, whether in the crypto economy or the real economy, you must put in the work to find the best opportunity. So I think this is a really smart thing. Okay, and there's a couple more sentences. It says, naturally, if you get it right, the payoff can be huge. So the same way you would buy a Bored Ape that might have really high potential future value, you can buy a townhouse that will be worth $100,000 more in 3 years, something like that. And then he says, conversely, if you get it wrong and don't diversify enough, you can lose it all. And the last most important part of this paragraph is that it's a brutal free market economy. And I think that's the most important, one of the most important takeaways is that the crypto economy is just as unforgiving as the real economy or the economies that we are familiar with today. And we're learning about these new digital economies and like this new frontier is that it's still can be, if you get it wrong and then it can be very tough. So
well, welcome to the free markets. I mean, this is something that
that's exactly right.
And that's where the opportunity lies, and that's where I get frustrated sometimes, especially what's going on now with, you had FTX blow up, and then the government steps in and says, we need to prevent people from taking risks. Like, I'll say this analogy all the time: 90% of businesses fail, but you don't see the government stepping in and prohibiting people from opening businesses. And so why should that apply to this new sector that's innovating and growing like crazy? I think it's absurd, right? People take risk, and if you fail, you learn, right? And learning is the only way you get better. And in this space, you're going to lose. There's everybody does. I've been doing it for 6 years. I've lost. I mean, it's not fun. But you know what I did when I bought some dumpy ass crypto coin that went from 3 cents to 0? I learned. Like, that's a dumb idea. Hey, Josh, why don't you stop following Twitter and actually do some research yourself and find products that are, and projects that are legitimate, right? And so there's a lot of ways to do that. You got to research what the team is. You got to research what the protocol is. Where are they building? Why are they building it? There's the tokenomics behind it. But all those things, exist in a free market right now. And if the United States wants to stop that from happening, you got to look going on in the United States, right? If the rest of the world allows this to happen, I don't know. That's a whole other topic, but I think that's a good place to wrap up. I think what he says about free markets is 100% true. If you get it wrong, you're going to lose, and that's how it should be, right? There's no backstop in this. There's nobody that's going to come help you out. But if you get it right, welcome to freedom. I mean, I think that's a worthy trade-off and worth some time to try to figure out. But anyway,
Agreed.
That's a great place to wrap it up. We will be back tomorrow, and looking forward to talking to you then. And as always, nothing we say is financial advice. Please don't do anything based off what we say. Our job is to show you resources to help you learn, and then you can make decisions for yourself.